Do you want to become an excellent trader or investor? Hi, I'm Crypto Quantamental, or CQF, and I want you to become the best trader or investor that you can be. In order to do so, you need to stop making these very common trading and investing mistakes. The first one that we're going to look at are trading costs. Trading costs are extremely critical, and many beginner traders and investors generally just ignore these costs. They generally come in two different forms: liquidity costs and fees. First and foremost, let's take a look at liquidity. Whenever you make a market order, you are paying what they call the spread, and the spread is the difference between the bid and the ask. In some extremely liquid stocks or instruments, the spread only might be 1 basis point or 0.01%, but I've seen spreads hit up to 8, 9, 10% in microcaps, or say illiquid cryptocurrencies, or those Satoshi cryptocurrencies. So you have to be very cautious not to get crushed by the spread. Also, if you are a big player and you have a large order, in particular a large market order, you might end up with a cost far greater than the spread due to illiquidity. You might end up having to dive deeper into the order books to get filled with your entire order. So when you're dealing with a stock or a coin that has a high spread and you're a big player, you're going to be paying quite a bit. Slippage is another factor in terms of liquidity costs. This generally occurs in high volatility where your execution is a lot worse than expected. In this case, think stop losses, in particular stop market orders. So in this case, you have a stop loss in place at whatever price, and it's set as a market order. So when your stop price is hit, it turns into a market order. But if there's high volatility and price shoots through your stop price, then your market order is going to execute far worse, far lower or higher, depending on what direction you're taking, than you expected, and that could be very detrimental. And also, oftentimes, the limit orders might not get filled. So if you don't want to pay the spread, you might place a limit order. But sometimes if they don't get filled, you're paying a high cost, which is an opportunity cost and not a financial cost at that point in time. But it's real, and it could hurt you in the pocketbook. What about in terms of fees? Well, it's much more straightforward. Most people understand the fees that they might be paying. However, they also could hurt you quite a bit. Higher turnover strategies or higher fee strategies tend to underperform. There's been a lot of research on that. But your fees could be highly variable. So it could be a percent of your total trade or a flat fee. If it's a flat fee of say $20 or $30, whatever it might be, well, you need to convert that into a percent to understand how well you have to outperform in order to make up your fee. You could be also paying per share. That can add up as well. And then you also have margin or lending costs, which is also a percent of the position. All these things could add up very, very quickly. Another major mistake beginners make, intermediate traders make, and even advanced traders make is they mismanage their behavioral biases. Every single person has behavioral biases. It does not matter who you are. It is part of being human. So the key is how we fight them and combat them. So you can beat them through discipline, a systematic process, journaling, having teamwork, whatever it might be. But you need to find a way to beat these behavioral biases. Some major biases that are out there, and these are only 5, but there's plenty out there. I posted a video on some behavioral biases, so I definitely recommend you checking that out. But one bias here is anchoring bias, which means you're relying too much on a piece of information. For example, your entry price. Let me give you a piece of advice here. The market does not give a crap what price you purchase a stock or a coin. It does not even really know that. So you should not rely overly on that piece of information. You have loss aversion bias, where the pain of loss is greater than the benefits of gain. You see when people move their stop losses to break even. This is one example of this bias. Endowment bias, overvaluing what you currently own. You see this all the time, where people own a stock or a coin or whatever it is, and they value it more simply because they're more familiar with it and they've owned it for a while. Overconfidence bias is when you overestimate your own ability. This happens all the time. You see this in the comic on this page where the one guy is asking if you believe in luck, and the guy says, only bad luck. How else can I explain my losses in the stock market? And then lastly, you have confirmation bias here. This is where you seek out information to confirm your belief. You're basically just a heat-seeking missile finding information to confirm your directional bias, whatever it might be. There's plenty of other biases out there. I recommend you check those out. But it's very important that you recognize what you're weak at and find ways to combat it. Another major mistake traders and investors make is not having proper or any benchmarks or not having very clear goals. So let me ask you, how do you define success? How do you know if you're doing a good job? How do you know that you can't access exactly what you're doing via a cheap index fund that costs very, very little for the exact same risk? So you need to understand this, and you need to have a proper benchmark and proper goals. Now, I can't tell you what your benchmark should be. I can't tell you what your goals should be. That depends on your strategy, your risk tolerance, and your overall financial situation. But I can give you some hints on how to select a proper benchmark. So one thing people utilize is what they call Samurai. And this gives you an idea of what makes a good benchmark. So a good benchmark needs to be specified in advance. You can't change your benchmark in order to make your strategy look good. You need to know what your benchmark is in advance. It needs to be appropriate. It needs to be measurable, as in you need to be able to calculate performance for this benchmark. It has to be unambiguous, so it needs to be very clearly defined. It needs to be reflective of your strategy. So, if you're picking U.S. large cap stocks, your benchmark probably should be the S&P 500 or the Russell 1000. They need to be very similar to what you're doing. A lot of ways people look at this is through quantitative measures like R-squareds or tracking error. It needs to be accountable, and it also needs to be investable. Now, these 7 different criteria, you may not be able to get all this depending on your strategy. It might be kind of difficult, but it gives you a pretty solid first step, a pretty solid foundation to look for a good benchmark. So here are some examples. I mentioned large cap stocks should be benchmarked against the S&P 500. Investment grade bonds should be benchmarked against the BC aggregate. But it can also get trickier for absolute return traders, but it's doable and absolutely critical that you find out a proper benchmark. That might be something like a Sharpe ratio benchmark or a cash plus return benchmark. They don't follow the Samurai process, but you still need something. If you don't have something, then you are just investing or trading in the dark. Another key mistake people make is they forget asset allocation. And the reality of the situation is asset allocation is extremely critical. It is more important than security selection. Okay, so the reality is, if I'm a stock selector and I love doing research on stocks, it is a lot more fun to try to find the next Amazon or the next Netflix or Tesla or whatever it might be, or deciding between Duke Energy and another utility company, whatever it might be. That the stock selection is far more fun, it's far more appealing, and it's a lot more glamorous. But the reality is picking your asset classes and having the right total risk between asset classes is far more important than just picking the right stocks. So what this means is having the right balance between stocks and bonds and commodities and currencies and cryptos and whatever it might be. So here are some studies that actually prove that point. So one paper called Determinants of Portfolio Performance included 93% of variation of your returns can be explained via asset allocation. Remember, asset allocation is like your stock percent versus your bond percent. Another paper said the equal importance of asset allocation and active management state that half of the returns could be driven by asset allocation. And obviously 93% versus 50% is a big difference, so I'll explain that in a second. So I view asset allocation as 2 different stages. The first part is what I consider strategic asset allocation. So strategic asset allocation is really started from your risk tolerance. So how much risk are you willing to take? What does your annualized standard deviation expectation? How much money are you willing to possibly lose? These are the sorts of questions you have to come up with to determine your strategic allocation. So here I have a strategic allocation of 70% equities, 30% bonds. So somebody determined that they're basically a moderate risk tolerance, and they don't want to take on 100% high risk equities. They want some bonds and some downside protection. So they come up with something like 70% and 30%. And this could be driven by how much money you make, your age, and a variety of other factors. I can't tell you what your strategic allocation should be. However, it is very important you come up with one. Now, this right here is what that 93% comes up from. So, way to think about this is somebody that's 100% equities, picking the Apple to Netflix, whatever it might be, for somebody that's 5% equities, much smaller percent in Apple and Tesla and the various other stocks. The difference in return here is not driven by the differences in picking the different stocks. So I might have Apple, you might have Microsoft. But the difference in return is driven by the fact that you have 80, 90% stocks and I only have 5 or 10% stocks. So that is what the determinants of portfolio performance is showing here. But stage 2 in asset allocation is just as critical. And this is your tilts around your strategic asset allocation. So in this example, if 70% equities, 30% bonds, but then you can tilt to 65% equities, 25% bonds, 7% commodities, 3% crypto. So your overall risk profile is still very much the same, very, very similar actually. However, you're doing it in a slightly different way to outperform your strategic asset allocation. Sorry, I'm bumbling around today. But the point being here is doing these two things, it is far more important than just picking the best stocks with the best cryptocurrencies. And many newer investors are totally naive to this fact. They'll just go all in on stocks, all in on crypto, think picking great stocks and picking great crypto is important, but it's not. It's really not in that case. What's important and what's driving your returns is your 100% stocks, your 100% crypto. That is what really matters in that case. And the last major mistake I have here is not managing risk. Now this is kind of a catch-all, and this is a very wordy slide, so I'd recommend you print this out, tack it to your wall, whatever you do. And here we have it broken up by basic managing risk, intermediate risk management, and advanced risk management. Everything I already listed previously applies. So you need to manage your behavioral biases, your asset allocation, understanding fees, costs, all that stuff is incorporated in risk management. But let's get down to a bit more specifics. So if you're a basic trader or basic investor, you still should need to know your portfolio expected volatility. You need to know your benchmark. You need to know your goals. You need to understand how much risk you have in a particular trade. And honestly, you probably should be probability weighting how much risk you have in a trade. So even though you might be risking 5%, well, what's the odds? What's the probability of that risk actually coming to happen? What about your cybersecurity, especially if you're in crypto? Are you protecting your assets? What's your potential for getting hacked? Things like that. And what about your peer group performance? This is very much linked to benchmarking and goals. How do other people perform with similar styles as you? From an intermediate risk management standpoint, well, what's your expected tracking error? To understand tracking error, you need to know your benchmark. So this is how much you deviate from your benchmark. What about your asset allocation risks? What can go wrong? What about operational backup plans? You might be getting data from a particular source. What if that goes offline? What if your computer breaks down? Whatever it might be, do you have backup plans? How about asset correlations? So You might own Apple, Netflix. Do they zig and zag in different market environments? What about Apple and Bitcoin? Do they zig and zag? What about different asset classes? Whatever it might be, you need to understand the correlations of the different things in your portfolio, upside and downside captures. So does your strategy, your portfolio, do better in up markets or down markets? Do you protect on the downside and underperform an upside? Is that how you win? Or perhaps you outperform an upside and get hammered downsides. It's important to understand how you perform in different market environments. It's also important to be able to look at your portfolio in hindsight and find out what worked and what didn't. This is very basic attribution to understand what stocks helped, which ones didn't, what sectors helped, which ones hurt. What about advanced risk management? It's still very important, even if you're a beginner. It's good to begin to understand some of these concepts. So what is your expected performance in stress-tested scenarios? What if the Federal Reserve raises rates? What if the dollar goes up or down in strength? What if we hit a recession? All things that may or may not happen, eventually will happen in some cases. How is your portfolio going to perform? How are specific assets going to perform in such scenarios? What about those behavioral biases we talked about before? What's your plan to mitigate them? Have you done any self-reflection to understand what you're good at and what you're bad at? How about counterparty risk? Now, this depends what you're investing in, but let's just take crypto because that's a pretty obvious example. If you're trading on exchanges, you have quite a bit of counterparty risk. Are you diversifying that? Are you on multiple exchanges to mitigate that risk? What about expected return distributions? This kind of goes back to the amount at risk in a trade. It's one thing to know that if a trade goes well, you increase your portfolio by 10%, and if you get stopped out, you lose 5%. That's great. But what about the distribution of those outcomes? Not just of losing 5%, but of gaining, you're hitting your target and everything in between. Something like VAR and CVAR is extremely critical in knowing your potential drawdown. So, how often should you lose 10, 20, 30, 40%? 5% of the time, what is your loss going to be? In a given month, what is your max drawdown potential? Understanding these sorts of left tail or drawdown events is extremely important from multiple different angles, whether looking at, value at risk, which is, 5% of the time, you should be expected to lose more than X dollars. CVAR would be, in the worst case scenarios, say the worst 5%, what is your average loss? And then drawdown in a variety of different ways. Expected asset volatilities. So what is your expected risk of Apple? What is your expected risk of Bitcoin? What is your expected risk of wheat? What is your expected risk of Netflix? What is your expected risk of the US dollar? You have to find a way to model those out and understand those. If you utilize optimization of your portfolio, you have to understand the pros and cons and all the sensitivities, as well as if you don't use optimization, you really can't plead ignorance here. You are optimizing it, you're just doing it in your head. What are the sensitivities to that? And lastly here, I have factor contributions. So the reality of the situation, if you own Netflix, Apple, and a bunch of other, kind of cool tech companies, what is really driving your portfolio? Well, in this case, there's factors behind it, whether it's, technology sector or momentum or whatever it might be. It's not just stock selection. There's a lot of underlying factors that might be driving your return. Some of those might be, like I mentioned, momentum or valuation or being high quality or low volatility. There's a bunch of different factors that might actually be able to drive your returns. So you need to be able to decompose your tracking error, your volatility. So what is comprising of your risk? What risk are you really taking? And lastly, be able to decompose your returns at the end based upon these factors, not just knowing that Apple contributed X dollars to your return or X% to your return, but decompose that into how much of my return is due to momentum or being value tilted you're having a high quality bias, you're having a low cap or a crypto bias, whatever it might be, being able to decipher that. That's very important for advanced portfolio managers. All right, guys, sorry about me bumbling a little bit, but I wanted to get through these major trading mistakes and investing mistakes that people make, whether you're beginners, intermediate, advanced. All of these kind of pop up time to time for all of us. So it's important to be aware of them and to be able to tackle them. If you found this helpful, definitely follow me on Twitter at CryptoQF, subscribe to this YouTube channel, comment below, talk about any other mistakes I didn't mention, and maybe we can kind of go back and forth on coming up with strategies on how to defeat them. Anyways, appreciate your time and safe trading out there.